Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market Site, we have Brian, Joyce, and Maddie Radner, both from the Nasdaq Market Intelligence Desk, as well as Doug Hubert, Deputy Chief Investment Officer of Wealth Enhancement. We're here to discuss how fiscal and monetary policies could impact the stock and bond markets, factoring in what's happening with tariffs as well. It's great to have all of you with us. And Doug, there really is a confluence of factors that investors have to contend with. We know what the environment looks like now with tariff fluctuations and so forth, but fiscal and monetary policy is also part of the equation.
Yeah, absolutely, and thanks for having me on. I think across the board, obviously driven by tariffs, but now there's so much uncertainty about what's going on with fiscal and monetary policy, and there's a question of, is the Fed's hands tied here, right? As they think about their dual mandate of employment and inflation, is that growth side of the equation now a bigger piece of the puzzle? And it appears to us, at least, that the market is putting a little more weight on growth than it is at inflation at this point. Yeah,
and another challenge too, Maddie, is with what we're seeing in earnings, right? Mm-hmm. The reporting from the first quarter and being in line is one thing, but trying to figure out what your operating guidance is going to be like going forward.
Yeah.
We're hearing that in the conference calls.
Yeah, the guidance for companies has really been the main focus, and guidance has been really difficult to offer. Transcripts are showing really high uncertainty looking into the back half of the year. Morgan Stanley actually noted corporate uncertainty is the highest since the early days of COVID. So it's really weighing on these earnings estimates and earnings revisions. So of the 150 companies that have reported, 2 have increased guidance, 1 decreased, 22 have not changed, and 92 have mixed or uncertain, and 28 have issued no guidance. So there's just a lot of scrambling. Companies are issuing 2 guidance estimates. So there's just the uncertainty is adding to the earnings season this year.
I mean, Brian, a stock, as we've seen today with Amazon, can round trip in one session, which makes it challenging when you're trying to understand what the fundamentals look like and how you want to value these stocks. But from a technical perspective, if we could take a look at the S&P, what levels, what's discerning there, or that's key for you to see how the market holds up?
Sure. I mean, we certainly have had a nice rally off the April lows, up about 15% off the bottom from the S&P 500. We've had a pullback high to low of 21%, a little bit maybe more than that. And so what I'm looking at now is we have a price gap here at the 55.71 level. We're just below that, like pennies away. And then we have a falling 50-day moving average around 56.15. So if we can get above those expected resistance levels, I do think we maybe could push up towards 57.5, possibly 5,800. That's where we'll see the 200-day, I should say the 40-week moving average, synonymous with the 200-day. And that would be the bottom, essentially where we were at the bottom in January, the January low, which technicians are seeing as a double top price pattern. So that would be my next level of resistance. So if we can get up towards those levels, it's still only about 4% from where we're right here. So as you guys have noted, tremendous amount of uncertainty. We've seen a lot of these indices get back above the 20-day moving average. None of them are back above the 50-day average. At the sector level, we are seeing the defensive sectors above its 50-day, but still far from out of the woods.
Yeah, and you've noted here, Doug, a lot of traders are levered as well. When you think about the hedge funds, algorithmic traders, and what that does to the different levels is they're looking to, constantly position themselves.
Yeah, I think, different participants in the market have different objectives they're trying to achieve, right? At Wealth Enhancement, we obviously serve high net worth individuals and families, long-term time horizon, and so they're not usually the ones driving the market, right? It's players that have they're trying to make numbers on a monthly or quarterly basis. They're typically in as traders, not long-term holders, and so with all the leverage in the system, when that comes out, when that uncertainty hits, the degrossing hits, and as such, that kind of vacuum pulls back. I think the other thing we've looked at, another area we've heard a lot around is the basis trade. The levered kind of buy off the run U.S. Treasuries, short the futures, kind of capture that arbitrage. And I think the media has talked a lot about that being a huge part of the market, and they're really worried. We monitor it, but if you look at the growth of the U.S. Treasury market, that basis trade has kind of grown in line. It hasn't gotten any larger. It hasn't taken a bigger piece of the pie. So from a systemic risk perspective, I don't think it's become this thing that everybody's talking about of why the back end is staying higher.
Well, I mean, to your point, your clients aren't thinking about that day to day. What are some of the things that you're hearing from them from a longer term perspective?
Yeah, I mean, listen, I think they are thinking about it to some degree, right?
Right.
You know, they obviously watch the news, they hear what's going on, the uncertainty, they're worried about their finances, obviously, as they should be. I think we try to communicate very actively with them to talk about, you know, short-term price movements don't necessarily mean long-term value destruction, but you know, we're not just going to put our head in the sand either and say, yeah, just hold on, right? You know, we need to make sure we're monitoring the markets. We need to make sure we're monitoring the risks and getting to a point where if the markets start to price in some future, there is some, you know, visibility as to where we're going, right? We want to make sure we make our marginal adjustments based on where we think it's heading.
Yeah, and Maddie, of course, I have to go to you because I ask you this every time. The IPO pipeline,
Yep.
still strong in the back end, but it's
Yes.
a matter of finding that window.
Yeah, I think right now it's a matter of how much risk underwriters are willing to invest in, and right now with the uncertainty taking place, they're not willing to invest in that risk right now. So the pipeline remains really strong. There's a lot of companies looking to move forward with their IPO plans from multiple different sectors, but really until we get a little bit more certainty, maybe until we see rates can come down a little bit more, companies will wait until the back half of the year to move forward.
Yeah, but whatever the resolution is, they're just looking
Yes.
for some sort of resolution
Yes.
so that you're able to figure out what the environment looks like. Brian, I do have to ask you about gold, though. I mean, it's just had a phenomenal run, even you know before the tariff tantrum, if you will. So you know, the question is, what levels are you looking at? How you know, is this overbought at any point, or is there still interest there?
I certainly think there's interest there. We are overbought. There's a common saying, overbought can remain overbought for a period of time. The breakout that I had seen was in March of last year above the 2,075 level. At that moment, technicians looking at a longer-term 11-year time frame, you see that 11-year range is a pretty significant range. When you have a breakout from something of that size, the expectation is longer-lasting upside momentum. The minimum price projection we came up with in March of last year on that breakout was around 2,800. We didn't expect to hit it in 6 or 7 months like it did. So just a phenomenal move higher. We just came off of 3,500. That was the top. We now pulled back to what's, I think 3,320 is around last sale. It's hard to say how far the pullback can be. We'd have to pull back and pull up maybe some longer term retracement levels, but my bias is that this potentially could be a multi-year uptrend from here.
Yeah, I mean, even if it does pull back a bit, look at where it was going into it. Even you can make the same argument with S&P as well. I mean, there was a lot of exuberance, you know, to get 2 years of 25+% returns. That's kind of not the norm. That's the exception, not the norm. So there has to be some sort of expectation of right sizing.
Sure. The last 2 years, we haven't seen that since 97, 98. And this pullback initially started in December. It filtered through to the large cap growth last, which really happened in late February into March. And so we've seen that group really take down the broader averages into April when we have a lot of the liberation volatility,
right,
so to speak. And so we know the S&P 500 is now down 5% year to date, 9%, 10% from the highs. I think it's 9%. So we're, you could say, this is, we're not that far off the highs.
But
so
Brian,
to say, go ahead.
we were speaking earlier, and 5 out of the 11 sectors are still up year to date when we look at the S&P 500. It's really the Mag 7 that is dragging the kind of tech consumer sectors down with the rest of the broader index. The large cap space is still attractive right now outside the Mag 7, as we were looking at earlier.
What's performing well, or what's the top one?
Defensive, so
right,
utilities, materials,
healthcare.
Healthcare, yeah.
And that's a big part of the pipeline too,
Yeah,
for IPOs as well.
Mm-hmm.
Yeah. Are you hearing more demand from your clients as it relates to the private markets?
Yeah, absolutely.
Those seem to be, which I did a panel on that, excuse me, I don't mean to interrupt, but they tend to have more of a fundamental way of valuing them and not necessarily getting so stuck in the noise?
Yeah, absolutely. I mean, I think if you think about long-term, the definition of long-term is certainly private markets, right? And I think, for us, we certainly like private markets. There is considerations you have to think about when you enter into them, but we still believe that time is one of the arbitrages we have left in our kind of toolkit, and so private markets fit great into that first. Secondly, I'd say we like private markets because there's a lot more levers you can pull to accrete value, and then kind of with that time, it kind of comes to a better solution set over time. We think it's a really great way to access the meat of the economy.
Within the private markets, what's interesting?
Listen, I think we're keeping an eye on what's going on, obviously. I think the first derivative of tariffs is less impactful to the private markets, but the second derivative, if we enter a recession, is very impactful, just like it is to everything else. So we're not running at anything right now, but I think selection's important, and I think selectively inside of private equity, we still continue to like the small and middle market there. There's some interesting opportunities in asset-backed credit. We're keeping an eye on the direct lending space, but we still like certain providers there, and so it's more now kind of, I think we have a good base and just keeping an eye on it and maybe selectively, opportunistically adding if we see.
Which is so interesting because when you think about private credit, that really was born out of the GFC,
yeah.
right? So it makes you think now, if banks, especially the small and mid-sized banks, if they were the ones that were traditionally lending as it relates to a mortgage, it makes you wonder what credit looks like within the mortgage space to fill some of those gaps. Is that going to be the next area?
Yeah, I think we've seen this playbook a little bit, right? You point out after the GFC, a lot of corporate lending came off bank balance sheets and the private market stepped in. I think today we're seeing that in the real estate, commercial real estate and asset-backed credit markets where they continue to regulate them into a certain box, and when their vacuum kind of opens up, private markets are usually pretty good at filling the void. And so I do think the one benefit that a lot of these participants have is the structure they can bring into the deals, their underwriting and the covenants that they put forward. I think that gives, not broad brush, but I think there's a lot more protections and security there than maybe some of the underwriting of that era.
Yeah. And Brian, to wrap up here, let's take a look at interest rates for a moment, because we know that's a big part of the equation, especially when you're looking at companies that are reliant, like Maddie's small caps, in terms of accessing money at a more affordable cost.
So the long 10-year Treasury yield, we peaked in October, November of 23, up above 5%, and we've really been in a sideways range. The recent highs from April last year and from around December is 4.75%. So we're not as low as 3.8 like we were earlier in the early days of, say, when Trump took office. But so we've come off of that. We've been up really since the liberation announcement day move. So it's when I hear people in the street talk about how rates are going higher in the long end, they are going higher, but they're not as high as they were in 24. They're not as high as they were in 23. The curve is steepening, which is good for banks. We want to see that. And so when you see what was the initial move in the equity market, where it looked like flows were coming, selling was taking place by foreigners, flows were coming out of the capital markets, including treasuries, which is going to drive rates higher. I don't know how long lasting that will be in the treasury market. I don't think we're going to see this massive spike higher in reals because of inflation concerns. I think if anything, if things get that bad on the inflation front, I think maybe there would be more growth concerns will outweigh that, and I think that'll keep treasuries in check.
All right, appreciate everyone's insight. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.